Southeast Radio's Business Matters with Karl Fitzpatrick.
Well, in financial circles, Budget Day is often considered as the appetizer for the main event, and that's the finance bill. Renowned for containing a few surprises that are not announced on Budget Day, this year's finance bill is no exception. Of particular interest to entrepreneurs and business owners is the impact which the bill, if passed, will have on pensions. Here to talk us through these proposed changes is Tony Delaney, the CEO of SYS Financial. Tony, before we delve into the proposed changes to pensions, tell us about SYS Financial and how the business is performing.
SYS Financial, I'm the founder and CEO of the car, 10 years in operation next February coming, 22 years previous with New Ireland Assurance in some management roles. We have 5 offices nationwide, 60 odd staff, and our main focus is to provide financial peace of mind to our clients in many aspects of their financial planning, and very much an advisory firm where sometimes our industry can be driven by product. We all know in financial services we get paid commissions and we're very transparent on that. But for me and with all our team is the advice comes first and the rest will follow, and then it's down to the transparency around how we're getting paid and what we get paid.
While the annual budget is always subject to extensive media coverage, this is often the headline, whereas the finance bill contains the detail. So how has this finance bill been received?
Some people it will never affect, and other people it has. But I've been asked over the last couple of years, and in particular this one, and I'm saying, look, there's a lot of drip feed of information before the bill, but when it's passed, then just before it's passed, you can get slight changes. And the bill now looks like it's going to be implemented before January because it looks like we're going to have an election. And there's parts of the bill this year that people might decide to do a little bit of planning around it before it's passed. But in general, one of the main things, I suppose, was the standard funds threshold in pensions has been increased after many years. But there was a lot of other parts that were answered about prior to that, and that hasn't happened. So parts of it positive, and other parts of it we felt maybe very negative that they didn't implement other changes, Karl, and we felt they should have.
In the past, there have been changes included in the finance bill that were not announced on Budget Day. This year is no different.
One of the big things is we're all aware that auto-enrollment is coming to the Irish market after 20-odd years of deliberation. And only as of last Tuesday, some of the real finer print, it has come out now and said that when you're retired out of the auto-enrollment scheme, that the 25% will be tax-free and the balance will be under the PAYE system. And also on debt, that the payment will be paid out through the PAYE system. That is absolutely ridiculous, and it's one of the most negative parts of auto-enrollment and the finance bill. Whether they will change it or not, I don't know. But if you look at the rules versus your occupational pension scheme, how you draw down your benefits in a tax-efficient manner and on debt, I think auto-enrollment is very important for a million people in Ireland. But how it's going to be treated on drawdown, which never came out in the early part of it, is bonkers.
Business owners and company directors in the last number of years have been able to put huge lump sums from cash reserves in their businesses into their pension. The finance bill is making massive changes to that, isn't it?
Yeah, that only came out 2 years ago, this January coming, Karl, and what it was, it was to make maybe pensions less complicated. And if someone was in a position to write a cheque for 2 million, rather than having to be, the old rules were, again, trying to keep this very simple, is based on putting monies into your pension before 23, it was based on your service you had built up in that company and your salary. The more service, the more salary, the lower you were able to maximise it out. Those rules are still there. But in 23, they brought out new legislation, and I suppose what has happened is it has become fairly aggressive tax planning for some company directors, and, it was probably driven a lot by what they're saying is the public sector not being able to fill, in particular the deputy commissioner's job, that if someone got promoted to that position based on their service and salary in the public sector, they were going to go way over the 2 million, and it wasn't worth them taking the job because it was too penal. So there has been a bit of aggressive planning around it, and what people have to be careful is you have two set of areas. You have planning for retirement, which meets some pension standards, but then you also have, does it meet the revenue standards, Karl? And that's where a lot of this has come out and claiming the reliefs. But employing spouses, children, this is all of what has come out in this.
Okay, so what changes are coming in as a result of the finance bill with regard to lump sum investments into a pension
Under the new one now, what they said was, we're now abolishing what we brought out in 23, and now to put money into your PRSA versus your service and salary, which is PRSA is another word for a personal retirement savings account, which I say to clients is another word for a pension. Under that structure, it's simple enough. If your salary is 100 grand, they're saying if you want to match it with a PRSA contribution, it's going to be based on that salary. If your salary is $250,000, you can still put $250,000 in. Under new, you could have a salary of 10,000 and technically wrote a cheque for $2 million.
In the last week, I have seen some incredibly poor advice being provided online about what business owners and company directors could possibly do in advance of the finance bill being enacted. For instance, like a business owner should add his spouse or his adult children to the payroll and make significant pension contributions for them before this particular act comes into play. What are your thoughts on that?
Yeah, and realistically, you might say under the old pension rules, yeah, I can do that currently. But then what you ask yourself is the revenue. If the revenue came in and I employed my spouse and she happens to be in the public sector, for instance, which she is, how can I justify having her on a bona fide salary through that company? So your pension company could have received your cheque, processed it, put it into your pension fund, and all of a sudden then the revenue are saying, hold on a minute, this has been major tax aggressive planning. There's no bona fide employment here, so you're going to pay income tax that you should have paid on that pension contribution, and more than likely penalties. So it's not as simple as that, Karl.
When it comes to a pension, should couples be planning jointly?
That is a great question, Karl, and I think this is where our industry is wrong as a whole. And again, I like to use examples that, and again, if I use my own wife, Elaine, if someone came into the public sector to speak to her about her pension and her debt and service, and they don't include ask anything about me, that is not advice. That has been driven by product. It's been driven by, individual advice. So if you want to build a proper financial plan, Karl, and you need to look at, are we both extracting as much tax-free cash at retirement? Also, what is our income going to be at retirement? Not just on the basis of getting tax relief at the outset. Where am I going to be when I forward Kenya to 20 or 15 or 30 years or 10 years time? So for me, I often use the word as dual advice. And if you want to get proper advice, to answer your question probably very simplistic, is you need to sit down with the couples, and they can be married, cohabiting, and if that brings in all other scenarios into the card. The bottom line is, if you want to build a proper financial plan, you cannot exclude your spouse.
And in terms of making withdrawals from their pension after reaching the standard fund threshold, should they be staggered to avoid the higher tax brackets?
Yeah, and Karl, I suppose this is where I think expert professional advice comes in, because, and I was going to give you maybe how to answer this often best by giving an example. If I'm working for a company today, I would just call it one of the major multinationals, and I'm working for Johnson & Johnson or someone, and whatever, and all of a sudden I'm due to retire from that company and have a pension fund, even call it just 2 million, or even the magical new figure is going to be 2.8 million into the future. I am not going to be able to retire in the most tax efficient manner in that structure. So for me, because you're mentioning having multiple, what you're sort of getting at, Karl, is how could I stagger my retirement? And that's what I'm asking our top clients. Do you want to retire in a tax efficient manner? If you do, you need to be able to stagger your retirement, but certain pension structures, Karl, don't allow you that. So I have to make sure, meeting all the revenue and retirement, you know what I mean, the pensions, technical legislation, everything, that the structure they're in allows them to do that. And if you're in what we call an occupational pension scheme or a personal retirement bond or one contract, you cannot do that. So there's a structure you need to get into where you have multiple contracts, but you have to know, you have to use the legislation and know it. So it's not applicable to everyone. So if someone was retiring maybe now from a major company like that, I might say retire early and get your leaving service options rather than your retirement options. And that will allow us to get you into the structure that will meet you, to allow you to retire in the most tax efficient manner. And that means you can actually push your retirement out technically to 7 parts of retirement and your tax-free cash, and maybe defer some income tax in a very legitimate way, Karl, out to age 75.
And if someone exceeds the standard fund threshold through investment growth in their pension, will this still deliver a net benefit?
If you have to make no contributions, Karl, and you go over the limit, yes, it's very penal, and I mean it's extremely penal. When you map it out, it probably works out at, if you were, say, $500,000 over the, or any figure of the limit, you're really looking at a 40% tax, excess tax, and then you're also looking at your drawdown of your income. So really you could be approximately talking about 72%, Karl. But if I paid 72% tax and I made $100,000 without contributing anything, it's still a 38%, return. So there's absolutely nothing wrong with it. But one of the parts that has come up prior to the finance bill was how penal this is. And there was some talk, and again it's only all speculation and talk, that this could be brought down to 10%. If that was brought down to 10 or 20, Karl, I would be advocating for anyone not to be worrying about going over the threshold.
Over the past few years, there's been lots of talk as well about investing in property through your pension, whereby the rental income comes into the pension tax-free. What are your thoughts on this?
I don't have a problem with it, Karl. We have a fairly substantial book, in that space. And sometimes, it's an Irish thing, want to buy property, but again, there's rules around it. It has to be at arm's length. You can't live in it. You can't have any connected parties. But it is, if you get, like everything else, when I buy a house today to rent, I'm not convinced because of the price of them. But if you buy it and there's capital growth, your capital growth is tax-free. But if the market drops, well, then your pension fund is dropped with it. And we all know what happened in the financial crisis in 2008. Again, it's not for everyone, Karl, but there's a lot of people out there like it. And what they do is they buy a property, then they invest in other alternative assets rather than your traditional, what we call life company wrapper. So it's not for everyone, but if it meets your risk exposure and you can get a good yield, well then, we have clients on property funds averaging net of fees 10% per annum in some cases. But if you're buying a property and you're only going to net 2.5 or 3%, well, it's up to the advisor to look, is this really a good investment? And you're solely dependent then on an increase in asset value, which we all know where property prices are today.
I think one of the other benefits of that as well, of course, is compounding, because if you have the rental income coming into the pension tax-free, you have more money in your pension to invest in stocks and shares and other diversified asset classes as well.
Yeah, and look, if you're buying a property, like I was saying to clients, is the rent goes in tax-free, or you want to buy a washing machine like the pension fund, you can't use any of your own money, Karl. But I did see someone criticising online only this week, in the last couple of days, anyone that has property in your pension fund, are you sure it's a good idea? And some people have a negative thing around it. But it's down to individuals, not what we want. Our job is to advise the client with the risks, the pros and the cons of what they want to do. But for me, it still only would be part of it has to be a diversified portfolio, Karl. So if a client said, I have $1 million in my pension fund, I'm buying all property, we wouldn't be really recommending it to do that. But some clients will come and say, I understand the property market inside out. This is what I want to do.
And finally, Tony, I do think that lots of people listening this morning, they do go out and take independent expert financial advice. But maybe one thing they don't put enough of focus and energy into is getting independent expert tax advice. How important is that?
Absolutely unbelievable. I always use my little analogies. If you went to the doctor today and he or she told you there was something wrong with you, where did they send you to? The consultant. It's the same with some of this, that when I meet someone and say, look, lads or ladies, that's above my pay grade, and you need to go to the expert. And having that tax structure, I couldn't speak highly enough of that. And it's not always high level individuals require that. It could be even transferring, your farm, maybe a house. Is your will tax efficient? That's one of the things I've come across a lot, is even people having wills made and not being anywhere near tax efficient because they didn't understand how to meet the thresholds. Then I leave it all to my children, where they should have named, spouses, their children's spouses and grandchildren. So in other words, they're paying out tax. They're leaving the revenue money that they could have done in a very legitimate way by having the structure in place, rather than having aggressive tax planning, have informed tax planning.
Well, if you've just tuned in, that was Tony Delaney, the CEO of SYS Financial, and the information which Tony shared with us this morning could be invaluable to the entrepreneurs that are listening to this morning's show.
Southeast Radio's Business Matters with Karl Fitzpatrick.